This episode of the Old Dogs REI Network is brought to you by Mino Studio.
In a world where jobs are how most people make money, one man, one desire, one challenge dares to break the mold. Welcome to the Old Dogs REI Network, where we don't work for money. Money works for us. Coming soon. Viewer discretion advised.
Welcome to the Old Dogs REI Network, where cash flow is king. Real estate investing, the means, so you can enjoy your retirement dreams. This is the show where we cut right to the chase. No sales pitch, no long monologues, just simple how-to real estate investing advice, so you can earn the passive income you need to enjoy your retirement today. And now, your host and chief old dog, Bill Manacero.
Welcome to the Old Dogs REI Network. I'm your host, Bill Manacero, and this is the show where 50-plussers and anyone else who wants to join us get solid, no sales pitch real estate investing advice to help generate real cash flow. This podcast airs twice weekly on Mondays and Fridays, and if you aren't already a subscriber, go to iTunes, type in Old Dog, spelled D-A-W-G, find our podcast, and subscribe. Well, I am really looking forward to today's show. We have a revisiting friend of the podcast here, a great guy, and he had previously appeared on 2 other episodes. Our listeners just loved it when he's on the show, and so I'm real excited to have him back. First one was 025 was the episode called Diversifying Your Real Estate Investments, and that was in August of 2016, and then came back for 077, episode 077, Funding Your First Big Real Estate Deal. Both of these are great podcasts. That one is in February 2017. So there'll be a link to those podcasts so you can check those out. He'll also get a lot more into the typical questions we ask, everything from favorite real estate books and so forth in those the very first episode. So you'll be able to get some great information. Every one of his interviews has been information packed. And if you haven't figured out yet who I'm talking about Nizan Mosery. He has been involved in real estate for the past 20 years plus and currently owns over 120 million in properties nationally and internationally. Just a little on his background. While living in New York, he owned a construction company and worked on numerous single-family homes, multifamily, and commercial projects of up to 300 units. In 2009, he relocated to Florida and became a licensed real estate professional, serving the South Florida market. He owns K.E.A.N Realty Solutions, a Florida-based real estate brokerage firm, and also a commercial brokerage firm, Commercial Realty Partners, the Commercial Advantage, in South Florida. Nizan and his team head up the multifamily division. He's also owner and CEO of K.E.A.N Management Solutions, a hands-on boutique professional management company, and Cornerstone Investment Partners, a commercial acquisitions and syndication company. Wow, does this guy sound busy or what? His expertise includes managing commercial assets, recognizing emerging markets, property management, syndication, mentoring, and advanced creative financing solutions. And he also hosts a new radio broadcast called the Traveling Investor Radio Show, a weekly radio program on W4CY.com. And of course, there'll be links to these things here, so you'll be able to check out his companies as well as his new show. Well, I'll tell you, you just tire me out, Nizan, just reading what you're doing here. Welcome back to the Old Dogs REI Network.
It's great to be back, Bill. Thanks for having me on the show. I appreciate it. It's always fun speaking with you.
Well, the pleasure is always ours, and I'll say mine too, because every time I have you on, I learn a ton of stuff. So I am totally stoked to have you on. We were chatting before this, and there has been a real change in the marketplace for real estate investors. I happened to hear a little bit about what you were doing and some of the creative ways that you're dealing with this changing market. So I am going to turn it over to you and just talk a little bit about what you're doing. What have you doing since last time we've talked to you? What kind of properties, what kind of acquisitions, what kinds of things, and then we'll get into the strategic side as well.
Sure, absolutely. Well, many years ago, when we were just coming out of the recession, we were looking in primary markets. The Dallas-Fort Worth market. Down in South Florida, the Maine markets, in different states around the country in the primary markets, because these were the hottest areas, and this is where you would be able to find the best deals. We never try to reinvent the wheel. We just try to use it to the best of our ability and tweak it for us. And what we've noticed time and time again is that it started to get harder to win the contracts from the sellers. And the reason why it was hard, I was talking to somebody, and it's funny, they kept saying, and I think I can relate to it, is that we were always the bridesmaid. Many times we were the bridesmaid. We went to the ball, we went to the dance, we put in our offers, but yet we always had these bigger institutional players that would come in and throw down anywhere between $100,000 to $500,000 of non-refundable money day one. Now, I can't compete with that. I'm not going to put my investors' money at risk. I'm not going to put my money at risk like that, because we don't have the 10, 20, $30 million sitting behind us that we can afford to do that. So we had to kind of reshift and look at what was going on. And we started going into the tertiary and secondary and tertiary markets of these primary markets that we were working at. And what we found was that, first of all, you can go in and you can get a better deal. Meaning, you're talking to a lot more of the mom and pop owners that have owned the properties for many years. They don't like to rock the boat. What do I mean by that? They like to go in, they like to buy a property, and this is like a Coca-Cola stock for them. They buy it once, they put in the tenants into the property, and they leave it there to cash flow for as long as they own it. Raising rents is not a big issue for these people because, they bought it 10, 20 years ago. They got a good deal on it. They got a good mortgage on it. They probably paid off the mortgage already on the property. So they're sitting on a nice asset that's got some great value add opportunities. So we would go in and we would start buying the 100, 150, 200, 240 units and so forth in the secondary and tertiary markets. Now, of course, once you see that and you're in that, the big guys themselves, the big players, the funds, the REITs, the real estate funds, all these family offices, they have a lot of people on their team that do a lot of investigative work. They go out and they investigate markets. They see where is the new trend happening, where is the best bang for your buck. And they started going into the secondary and tertiary markets as well. So now we're competing with these guys again, just in these secondary and tertiary markets. So we kind of sat back, scratched our heads and said, okay, what are we going to do? How can we shift? Where's the next niche coming? What can we look? And we found that anywhere between the 40 to the 96 to 100 units, no one's buying these, right? These are too small for the institutional players. They don't want to go in and buy 70 units or 60 units or 80 units or 90 units. They're looking for the 100, 200, 300 units, right, to go in. So we said, you know what? Yes, we always tell our investors, and when I educate and when I talk to people and on my radio show, it's always been go big, fast. How big can you go? How fast? For me and for my team, that strategy has kind of changed right now. What we've done since the beginning of 2018 is we said, okay, let's let's go a little bit smaller. Let's go to where these institutional players aren't even looking at. And we started acquiring. We acquired a 44 unit, a 50 unit. Now we're closing on a 76 unit, and we've got a 96 unit behind it that we're under contract for as well. And what we found is that no one is looking at these properties. And the people that are looking at it, we have a stronger track record than anyone else that's competing for these properties. So we go in and we started buying 1, 2 properties. We showed the brokers that we are able to close, we can close quickly, and we can move forward. So that kind of starts triggering in the broker's mind, well, you know what, I've got a player here that likes these types of assets. And what they've done now is they've started funneling us these assets. So we've got now another funnel of the 40 to 100 unit properties in the markets that we're in. And, like I said, the owners have held them for several years. It can be some of them are investors as well that have held them for a couple of years, and now they want to, they're kind of growing out of that size range. They want to go into the bigger 100, 150, 200. So they're looking to release these properties as well. So we go in and we acquire these properties that have a very, very strong value play in these strong emerging markets. And just to give you an example, the first 2 properties that we closed on, while we were under contract, the on-site property manager was raising rents on new leases to just about our pro forma numbers post renovations. And we haven't even owned the property yet, and we're already making money. So,
Gee.
yeah, and I just want to reiterate that again so people understand what I said. We created our pro forma numbers, and I'll give you just an example. These numbers aren't real numbers. I'm just going to give you kind of like, the scene. So let's say we put the property under contract and a studio apartment was at $550. We projected in our numbers that after, about a $2,000 renovation package, we would go in and we would raise the rent $50 to about $600. While we were doing our inspection and our due diligence, and I flew to the market to walk the properties with the inspectors and everything, the property manager was getting a studio apartment ready to rent. And I asked him, how much are you renting that? He goes, oh, I'm renting it for $600 now. We just raised it $50. I said, what are you doing to the property, to the unit? He goes, absolutely nothing. We're painting the walls, cleaning the carpets, fixing up the little things here and there, and that's it. So he was raising the rents already to the level that we were going to raise it once we renovated it. So that goes to show you how important it is to get into a emerging market, but you really have to know what's going on in that market. You really have to become the expert. You have to know, why are people migrating to this area? Where are they migrating from? What kind of jobs are happening? Are these temporary jobs? Are these permanent jobs? You really got to know the area, know the market really well, understand the other properties around you and what they're offering and what you can offer, and to maximize your profits as well. So we've been very fortunate to be able to hit some really good assets in these markets.
Okay, for our listeners' sake, and we've used these terms and a lot in the show throughout different time periods. Give us an example of like a major MSA and then a secondary and a tertiary market. I mean, you don't have to reveal
Sure.
where you're looking or anything, but you give an example of what a secondary market would. They might have heard of, and what would a third tertiary market sound like in that same MSA?
Sure. So let's take Georgia. Okay. Georgia is a great state. There's a lot happening there. And if you look in the Atlanta market, Atlanta was a very strong primary market. There's a lot of things happening there. A lot of people moving from outside of Georgia, outside of Atlanta, to Atlanta. Okay. And then, so from there, we went and we're looking at, let's say, Stone Mountain. Okay, Stone Mountain is a little east of Atlanta. Stone Mountain, about 10, 15 years ago, was a very desirable area. Okay, a lot of properties were being sold, a lot of good houses, but it kind of dropped down again. It kind of went down. People started leaving the Stone Mountain area. But what's happening, because now people are moving out of Atlanta, they're getting priced out of Atlanta, right? The quality of life is decreasing. So they're moving to an area like Stone Mountain, which is very close to Atlanta. So now what's happening is, a lot of people will say, oh yeah, but Stone Mountain, that market was going down. It was going down. There's probably not much job growth happening in Stone Mountain. However, what we see is a lot of migration is happening that is commuter migration. People are moving to Stone Mountain that are going to commute back to Atlanta. And then if you go a little further out, let's say to the northeast area of Atlanta, you've got places like Commerce or Lilburn or Athens, Georgia, which is right by the University of Georgia. Lilburn is sitting in Gwinnett County, which is, I think it's one of the fastest growing counties in Georgia, and it's going to outpace Atlanta in growth by 2020, 2030, something like that. So, these are the kind of markets that we're looking at right now to go in and to start acquiring these smaller assets. So you want to go out, you want to see where the path of progress is going. Where is the path leading? Where are people moving to? Why are they moving to? Where would people move to if Atlanta got saturated? And Stone Mountain is very close to Atlanta. Athens is very close. Commerce is close. They're about an hour outside of Atlanta. Now, for somebody who was paying $800-900 for a 2-bedroom, 2-bath apartment in Atlanta, they're now paying well over $1,000 for that. So they're going to go to these different markets and they're going to look for something that is very similar in price to what they paid for in Atlanta. And if we can go in and offer them a nice place to live, trees, a quiet area, with nice amenities where they're going to pay maybe the same, if not a little bit more than what they paid in the Atlanta market, and yet we're still the lowest priced asset in the area, we're going to pretty much be occupied all the time, and we're going to have room to grow.
Great. So you would say that both the secondary and tertiary markets are within commuting distance of a major MSA like Atlanta?
Yes, they can be also. And, a lot of secondary and tertiary markets now have their own job growth. They have their own little areas. Like, for example, Athens. Athens, Georgia has the University of Georgia in Athens. We're closing on a property half a mile from the university. The university injects $14 billion of economic stability into Athens on a yearly basis. They got 36,000 students. They've got over 10,000 faculty, and they're growing.
Wow. Okay. So these centers, as people start moving a little further out of the city, they're actually, services and other things are coming to the area. Well, the university is a staple. That's almost like a government seat or something, right?
Right.
I mean,
right.
But you also have, as people are moving further out, they need services, dry cleaners and Walmarts and whatever to,
exactly.
to be available. And so they're starting to develop their own employment pool and so forth.
Right. Right. Yeah. And, when you go into these secondary and tertiary markets, you want to look, where is there a Starbucks? Where is there a Domino's? Is there a Walmart next to it? Is there a Whole Foods? Something that is a strong chain. If there's a Starbucks, half a mile away from an asset that we're looking at, that tells me that there are people in this market that have spendable cash that they can buy a $4 cup of coffee.
Mm-hmm. And that Starbucks is put the money behind the research to really look at that area. I guess I'd also go with like a Whole Foods or Panera,
a Home Depot,
right?
Exactly, Panera, Home Depot. Any one of these chains that are national, they do their homework. They're not going to spend money to open up a place if they haven't checked the demographics, the incoming and outgoing, the flow of migration. So this is a good, kind of a good marker for anyone who's looking to buy in a certain market. What chains, what franchises are around the area? Are these small mom and pop chains that have, maybe there's one or two franchise company, in the country, or is this a huge thing, right? So
Right.
you want to check that out as well. And also with the tertiary and secondary markets, if the job growth isn't there, okay, you want to see if it can be a commuter market
Right.
to the major metropolitan area, right? Like Stone Mountain. Stone Mountain is a great commuter market. People will live there, but they will, the job growth might not be there and so forth. But what happens is the people that are being priced out of Atlanta are going to move to Stone Mountain, and then they're going to commute back and forth.
So how long a drive are you looking at that would still be a reasonable commute? I know it may vary from market to market, but just in your own sort of rule of thumb.
I would say, no more than an hour and maybe 20 minutes. I know in Texas, people don't mind driving, an hour and a half, 2 hours one way to get to work because everything is huge in Texas.
Right.
So for them to get into their gas guzzling Ford F-150 and drive 2 hours, for them it's nothing.
Right. Just put some good road miles on their car there.
Exactly.
All right. Oh, that's very interesting. Now, do you do your own market research, personally, or what are some of those key indicators that you look for as you're going in those secondary and tertiary markets?
Yeah, sure. So we look to see, we do our own market research. Plus, we also, look at other, we look at, at articles in the news that are coming out. Like I was, before we got on the call today, I was reading a couple of articles that's talking about the yield cycle that's going on because now the Feds have raised interest rates and they're looking to raise interest rates again. Now, when the yield curve talks about short-term yield versus longer term, okay? When the gap between the shorter and the longer term treasury yields, when they stand near its narrowest, it tends to sometimes invert. And historically, when this yield curve starts to invert, anywhere between 18 to 24 months after that, and this is a historical thing. It dates back to the 70s and the 60s. At every time the yield curve inverts, within 18 to 24 months, we go into a recession.
Really?
So, yeah.
Where are we in that cycle right now?
We're right at the beginning of it. It's starting. The yield is starting to invert. So we have another 6 months where we're working and it's going to happen. And then, I think within 18 to 24 months of now, we're going to go into a recession. So if people are looking to buy, you want to really buy with a long-term strategy. I would not look at 3 to 5 years right now, because if you're looking to buy a property now and you're looking to get out of it within 3 to 5 years, you might end up holding it in a recession. And if your mortgage, if your debt is a 7 to 10 year term, or even a 5 to 7, and we go into a recession, you may be in some tricky waters. So, of course, every market is going to be different, right? Atlanta is still a booming market. The Southeast is a booming market. But every market is different, and every market may start that recession at a different time. So you really want to be careful. You want to do your homework. We go out, we check migration. Where are people moving to? Why are they moving there? We check how many families are moving into an area. We're looking at job growth, right? For us, the holy grail is job growth, right? Job growth. How many jobs are being created? Where are they going, right? We have a president now that has taken our economy to new heights. Can that last? The issue with what we're having now is with all the tax reform and whatnot, people are saving money. The problem is the money that they're saving, they're not actually saving. They're not putting that aside. They're spending it. So the spending level increases. So the kind of the ratio of where they were a year ago to where they are now with that new savings is still the same. People are spending more because they're making more. They're not saving. So we got to look at all these different factors. We got to look at different articles. We got to, you can go on Google and just Google yield cycle. And then you'll get all these different articles, and it talks about the different, the long-term yields, the short-term yields, what's happening now, what's, all the different countries, what are they looking to do. It's very complex, but if you can pull out the small, tiny details that are important to us as multifamily and commercial investors, the warning signs are starting to, the lights are starting to flicker and say, hey, 18 to 24 months, be ready.
So is that affecting the types of products you're looking at in terms of how you're funding these projects? Are you funding them differently than you were, maybe 5-10 years ago? Are you looking at shorter term vehicles? So are you doing anything differently from the lending side?
So when the recession hits, there's going to be a lot of private money that's going to be looking to invest. So you'll still be able to get financing. It's going to be more of a bridge financing. It's going to be maybe higher yield, higher interest rates than normal. Fannie and Freddie are going to be tougher to get loans when this happens. So you want to look at a longer term hold, right? Longer term mortgage, maybe 10, 15 years rather than 7 to 10 years. You don't want to be caught with your pants down, right? And suddenly you got a loan that's coming due in a year, and you're in the middle of a recession and you don't know what to do. So you want to get a longer term mortgage so that you can really, ride through that wave of uncertainty and downturn. So we're buying also properties that, when we're underwriting extremely conservative. We're underwriting where, let's say in year 5, if we're buying now, we're doing a 5-year hold. And let's say now the cap rates that we're buying at are a 6 cap. But they're a 6 cap because it's a true value play. The income is low, but there's strong value play. Our exit strategy is to sell in year 5 at an 8.5 cap rate or even a 9 cap. So imagine if we're on a downturn, right? In 18 to 24 months, recession, things are going down. We want to go sell, and now properties are selling at an 8, 9, 10 cap. When we underwrite it today, can we sell in 5 years or in 6 years, even in 7 years, at an 8, 9, 10 cap and still get paid and still make money for our investors? And if the answer is yes, then you're okay. I don't want to say you're great or you're good or, nothing is guaranteed, right? But at least we're looking to minimize the risk for our investors when we get into a recession. And if we can do that, then I think we're okay.
Is your criteria to buy properties under market, or is that just impossible right now?
Under market, well, it's... Again, every market is different, depends on the market that you're going into. We're buying properties that have a value play, so the rents are below market. I wouldn't necessarily, the prices are below market, the rents are below market. And we're looking to increase the rents. And let's say, what happens if, we go in and we raise rents, 2 years down the road, there's a recession, and we have to bring the rents back down to where we bought it at. If it cash flows today, with our new mortgage that we're putting in it, then we're also okay. So you got to really, you got to do the stress test. What is the minimum, what is the maximum occupancy or vacancy that we can have to still break even? Can the property today, at the rents that we're getting today, right? If the rents are below market, can the property maintain the debt service payments with the rents that they're getting today, which are below market? And if yes, then we're good. And can we sell it in year 5, 6, or 7 at an 8, 8.5, or 9 cap and still make money for our investors?
Right. Yeah, that would be, I would think, a major concern. If you've got an 80% loan, or if you can get one, where you've got that 20% gap there. But if values really decline, I don't know that would happen. The bank would come in and ask you to make up the difference if you encroach into that 20% there. That would be my concern. Is not allowing as happens in recessions, that the property values may decline, and if so, can you maintain the debt and not have to come up with additional cash there?
Right, absolutely. That's what you got to look at. It's a crazy market that we're in right now. There's a lot of money out there. There's a lot of money that needs to be invested, right? So we gotta look at, now is the time to go 30,000 feet high and look at the market and see what's going on, right? I was talking to a broker. He says that he's got a group that is looking to buy 200 plus units at minimum 5.5 cap rate. And we were talking about the inverted yield cycle and, the recession coming and so forth. So I asked him, I said, if this is happening 18 to 24 months and they're looking to buy at a 5.5 cap rate now, what are they thinking? So his response to me was, this particular group, they buy and they hold. They hold for 20 some odd years. So they're not worried about, having to sell a property at any given point. They can ride, they'll ride 2 or 3 market cycles and they're good to go. So it also depends, if you're buying a property and you want to hold it for the next 20 years, that's one strategy. If you're looking to buy and get out quickly for your investors, you got to really look at what's going on. You got to look at the Fed. You got to, talk to, if we're investors, talk to some brokers, commercial brokers that are out there that are in the field every day that understand this, And this guy that I spoke to, he was a wealth of knowledge. When I talk to brokers and I talk to other investors, I like to hear what they see in the market, because I see what I see, but I don't necessarily see everything. So I like to get a hold of other people and get educated from them and hear what they say. Right?
That's great.
They always have something new to add, and I learn a lot just by listening to other people that are in the market, that are in the field as well, doing this on a daily basis.
That's why we love talking to you, because you're not only a wealth of information on your own, but you are connected well, and you do get some great data out there. Hey, old dogs. I don't know if you're like me, but it's easy to get overwhelmed trying to manage and track multiple properties, juggling multiple bank accounts, and trying to determine just how much money we're actually making each month. Normally, I spend a lot of time manually inputting and updating my various spreadsheets to just keep track of everything. Well, we have a new sponsor here at the Old Dogs REI Network, and they must have been listening to this show, because it looks like they've developed a solution just for me. I'm talking about a new company called Stessa. Stessa lets real estate investors automate the busy work so we can focus more on the things we love, like growing our portfolios and spending time with our families. To set it up is very easy. All you do is just take a few minutes to add your properties and link your accounts, and your income and expenses will update automatically. And what's really cool is that you can see all your properties and key performance metrics in one central dashboard. To learn more and get started with a free account, go to stessa.com/dog, of course spelled D-A-W-G. That's Stessa, STESSA.com/dog. Now, you've been in a lot of different asset classes too, and I wanted to ask you about that. Have you, although it sounds like you're still very active in multifamily, are you seeing more promise in other commercial asset classes, or are you actually avoiding, whether it's commercial buildings? I know you had like a marina or something, right?
Right.
Yeah. So what are your thoughts on those other asset classes in light of what's shifting in the economy right now?
So that's a great question. Outside of multifamily, right? Everybody always needs a place to live, right? So that's why multifamily is a great asset class to get involved with. When you're looking at hotels, when you're looking at marinas, or even self-storage facilities and things of that nature, these are things that when the market is good, they're doing really well. When there's a recession, people start to well, I don't really need everything in my storage unit, so I'm just going to go there, take whatever I really need out of it, store it in my house for a couple of years, and I'm just going to give back my storage unit. A hotel, people don't travel as much, right? So your occupancy is going to go down. Marinas and vacation resorts of sort, people lose their boats. This is extra money that they have to put out for things that they may not right now have that capital or want to retain a lot of their cash, right? Because in a recession, what's the big phrase that we always hear? Cash is king, right? Mm-hmm. So just like multifamily, you want to go out there, you want to do your homework, right? You really want to do your homework and make sure you're buying a property that is truly a value add, so that if, as we said before, when you're putting on new debt, will the property as is right now with the lower rents, lower occupancy, can it maintain the new financing on the property? When we bought our marina, before we bought it, I obviously flew out to the Carolinas and I walked the units and I walked the properties. And my main concern was, what happens if there's another downturn? People are going to sell off their boats. The marina's going to go, vacant, right? It's going to go empty. Nobody's going to have their boats there. What's the story? So I was there and I was talking to a couple of people, and I met a few people that live in the area, and they said to me, one guy, I love the way he put it. He goes, "Boy, you can take away my house. You can take away my wife. You can take away my car. You do not touch my boat, my dog, and my six-pack."
Love it.
So he basically went to tell me, he goes, the community in that area, they are boaters. People go out and, even though it's a lake, this is what they live for. They come home, they get on their boat at the end of a day, on the weekend, and they go out to the lake, they throw a couple of rods in the water, and they just sit and enjoy. This is their lifestyle that will never change. They will do whatever it takes to maintain that lifestyle in an up economy or in a down economy.
Interesting.
So this is the kind of information you want to pull from people when you're going out and you're doing your market research, right? You want to go out and, and again, is it the kind of boats that the middle class, is buying because things are really good now? The economy is doing well, and when the economy goes down, they're going to sell their boats because they can't afford it? Or is this the community that this is a lifestyle? They've paid off their boats 20 years ago, and they're good. The boat is part of their family. So
got it. Interesting. Well, would you be willing to share what some of the top markets you see, at least currently, or maybe in the upcoming season here, where we think there's some good opportunities still?
Yeah, sure. Mobile, Alabama is great because you've got the Boeing factory, the airlines, they're expanding now. We have the southeast quadrant of the U.S. Southeast quadrant for me is northern Florida, central to northern Florida, all the way up to the Carolinas. And that engulfs a little bit of, Alabama, as I mentioned, and the eastern part of Tennessee. Now, I'll give you guys a freebie. Pensacola, Florida. Okay. If you look on the map, it's on the Panhandle. It borders Alabama. There's actually a great bar that sits on the Florida side and on the Alabama side. And guess what the name is? Florabama. What an ingenious name. Right?
My goodness. I love it.
But let me tell you this. The Navy, the feds, are moving, the Navy feds, they're moving their bases, the naval base over there from, I think, Virginia or somewhere. And they're bringing in over 4,000 jobs. They've already absorbed about 2,000 jobs in the Pensacola market. So this is a hot market. If you want to go into a market and you want to go in, but again, okay, buy right. It's all about buying right. Okay. And if anybody needs a sponsor to go in and to help them with that kind of stuff, feel free to reach out to me. I'd be more than happy to discuss this with anyone and to give you my 2 cents and to help with the financing and so forth. But right now, Pensacola, Florida is one of the top markets that you can go in because of this job growth.
That's great. Great tip. Wow. Thanks. And Mobile's good. What's the other one in Mobile that was supposedly doing Huntsville? Is Huntsville still good or?
No, Huntsville is still good. Huntsville is very good. Yeah,
great,
absolutely. Now you can also go. A good way to find out where is a good market is to look at the residential market, right? Housing increase, pricing of houses. Are more people buying houses? Are prices going up? What level of houses are being bought? You always want to look at the middle. You don't want the high-end luxury and you don't want the low-end. So you're looking anywhere between $200,000 to $350,000 price range in those markets, right? So you look at the hottest housing markets in the area right now in the country, and you can call up a broker, a real estate broker. You can go online and just type in, top 10 hottest housing markets in the U.S., and you can research and see where are people buying houses. And then, okay, so they're buying houses here. Why? Then you go into the Economic Development Committee of the city. You go into the Chamber of Commerce and you ask them, hey, how come there's a lot of people moving into your neighborhood, into your town, into your city? What is the local government doing to attract all these people to come here? Is there job growth happening? What kind of jobs are being built? Any main companies moving in their headquarters? So that's a good way to start your research.
That's great information. Wow. Well, Nizan, this has been so outstanding in terms of just the quality of information, and you always throw in some great tips for people as well. Anything else you could think of that might be helpful in this area in terms of what people should be looking for or how they should approach purchasing right now during this market?
Purchase carefully. Okay. Do not be aggressive in your numbers. Always err on the conservative side. Okay, no one will ever accuse you of being a little too conservative. They will definitely accuse you of being a little too aggressive. Okay, don't let the brokers push you into something just because the broker wants to sell it or the broker thinks it's a great asset and whatnot. Do your homework. Go out to the asset. If you have to fly, drive, walk the neighborhoods, walk the properties, go and look at the other properties at what they're doing right now, and what kind of occupancy and vacancies they have, and definitely read about the yield cycle becoming inverted. This will help you out to understand where we are and where we're going. Okay, that's the best thing I could tell you right now.
God, that's great info, Nizan. Thank you so much. Thanks for taking the time, just to come out here. I mean, to come out here to talk to us on the, on the phone here. But anything else that you guys are doing that's interesting that, you wanted to share, or maybe if there are people that are interested in getting a hold of you as well?
Anything, we're out there. Like I said, we're buying the smaller units. We're going into really strong markets. We are building portfolios in good markets and good areas of smaller units, so that if we want to jump into the bigger units, we can always jump to the bigger units, because now we can show these family offices, REITs, real estate funds that we have local knowledge and a foothold in this market. So then they are a lot more open to stroking a check for $2, $3, $5 million, right? A lot of times, we're taught to go, and it's a great way of doing business, to go where there's an emerging market, right? Look at your emerging market, find an emerging market, and buy in an emerging market. That's great. Absolutely. but don't bounce around the country. Don't be like a shotgun. You know what I mean by shotgun? You pull the trigger and the bullets go flying everywhere, right? Mm-hmm. Find a market that's strong, that's growing, that's emerging, that's got really good growth potential, that you can actually see what's happening in that market, and then dig deep. Dive deep into that market. Once you dive deep and you've got a foothold and you become an expert in that market, these bigger players will be more prone to opening up their wallets and stroking a check for you.
Excellent information. Well, how people get a hold of you, Nizan? What's the best way if you've got some folks out there that would want to follow up or maybe present a property or something if you might be interested?
Sure. You can always email me. My email is nizan@investwithcip.com. That's N-I-Z as in zebra, A-N as in Nancy, at invest with, and it's 3 letters, C-I-P, P as in Peter.com. They can go on my website as well, which is www.investwithcip.com, and CIP stands for Cornerstone Investment Partners. You can also shoot me a text, 561-212-7247. Again, 561-212-7247. Or you can go on Facebook to my Facebook page, The Traveling Investor. And, you can reach me there, or you can reach me on Instagram as well as The Traveling Investor.
That's great. Well, thank you, sir, for giving us your time today. I really appreciate it.
Always a pleasure, Bill. Anytime for you, my friend.
Well, we appreciate it, and we appreciate you. I also want to thank all of our old dog listeners out there, too, for joining us. I know there's a lot of other things you could be doing right now, but the fact that you've taken the time to join us means a lot, and we greatly appreciate it. Please note everything that Nizan mentioned today. There'll be extensive notes in our Old Dogs website at the olddogsreinetwork.com/blog. And you'll look for the episode with Nizan Mosery. Well, that's the show for today. Remember, cash flow is king and real estate investing the means. Until next time, keep moving forward and may God bless.
Thank you very much for visiting the Old Dogs REI Network. We would greatly appreciate if you would stop by iTunes and let us know what you think of the show. We would love if you could subscribe to the podcast, give us a 5-star rating, and write a review. The more ratings and reviews we receive, the more visible the podcast will be to others. Thank you.